It'll be Laura and myself giving the presentation today. So we're going to be talking about accessing the right capital and talking about debt financing. So we were going to cover understanding cash flow and why cash is king, go over the credit ecosystem and why you would use debt financing and who provides debt financing. And then we'll bring it home and talk about how you qualify for credit, common misconceptions around your first loan application, and building a banking relationship. So cash is king, cash flow. We all know that without cash flow, you can't run the business. You need it to be able to pay your employees and pay your bills. A lot of the time, you'll be able to sustain that yourself using your own cash flow within the business. And if you can, that's great. A lot of the time in the beginning, that's usually what has to happen. But then when you find that you don't have enough on your own, that's where we can come in and provide financing for certain products that will be able to help you, such as a line of credit, business credit cards, term financing, and then as well credit cards, overdraft protection, sorry, for peace of mind. So cash flow management, cash helps fuel growth. You need it to, a lot of the time before you can start in that growth period, you need your own cash to exceed revenues in the early stages. And it's important to put solutions in place before the need arises. So we really stress on planning, knowing what your future plans or growth plans are going to look like. If you're going to be needing cash in 3 months down the road, you want to start planning for that today and not be reactionary.
I was going to comment that the banks are inherently conservative and risk adverse, and we as entrepreneurs are not. So you've got to play into the card that you're dealt in that they will access capital for you, but to do that you have to be methodical and proactive and communicative about what needs you have and what future plan expansion, if it's buying another company or whatever it's going to be. And I think that's how you allow them to succeed for you, because they're going to go to bat for their risk department to look at you and say, yes, we do want to back this company.
So keep the cash flowing, tips to help you monitor and manage your cash flow. Understanding your sales cycle. So like we'd said before, if you know that you're seasonal and you're going to come across a shortfall, you want to make sure that you've got extra cash on hand to take you through those times. You want to make sure that you're managing your expenses. And sometimes outsourcing certain tasks would make more sense so that the right person is doing the right job and you're not spinning your wheels doing too much of it and spending more time and money at the end of the day. Collecting from your customers on time. So it's really important that you are making sure that the terms that you've set with your clients, that you're collecting on that time. And if you are too busy doing other things and you let it fall, the likelihood is once it gets to 120 days not collected, it's going to be a lot harder to collect it than at 30 days or 60 days. And also the bank looks at it differently. So on your receivables, we'll ask to see aged receivable listings and see how effectively you are collecting that money. And then as well, how you're paying your suppliers. And are you using advantages in your favor to help the terms or pricing with those suppliers? And one of the things that we've been saying in all the other groups is, doesn't hurt to ask, be bold, and negotiate. You won't know unless you ask, and they can value your relationship, their relationship with you as much as you value it with them.
So the mentee that I had last year had lots of questions with respect to cash flow, and she was extending a lot of credit to customers, larger customers that were paying 60, 90, and 120 days out consistently, but always on that large sort of long-term view. And we changed the strategy for her. We sort of tiered her customers, and we asked for a certain tier of customers to prepay on a percentage of the work, and then essentially she was only carrying the receivable that remained on the 60/90. That helped with her cash flow. So there's lots of innovative ways to try to get your money quicker, obviously, and then pay your suppliers as slowly as you possibly can to create that cash flow and the opportunity.
And some measures that you can look at for those, and I don't know if you guys do them right now, but like your inventory days, inventory turnover, accounts receivable days, accounts payable days. That's basically your whole cash conversion cycle.
Can you say that again, sorry?
Yeah, for sure. So you'd have your inventory days, right? So how many turns do you do of your inventory? How many days on hand do you have? Your accounts receivable days. So on average, how long is it taking you to collect those receivables? And then your accounts payable days, right? Because if you think about it, you're buying this inventory. Maybe if you're lucky, you don't pay right away. And then you sell it. But if you're selling it to another business or someone with terms, now you've got an accounts receivable, but maybe you've got to pay that supplier. So you get your cash gap there, right? So monitoring those too for trends year over year, like has this been increasing? Is it getting longer? Am I in line with my industry and my competitors? That can just help you do a bit of a pulse check.
And the last is keeping inventory reasonable and relevant. So, like Laura said, you want to make sure that you're not holding on to inventory too long and that it's turning over at the right rate. The other thing we wanted to recommend is that you have a great relationship with your banker. They can connect you and put you in with resources that you might not know are available. There's a lot of grants that are available. If you're doing research and development for technology, or you're in digital media, as well as there's grants for food, hiring, training. You know, if you plan as the business owner to do your MBA, you can get up to $10,000 in training per year, up to 50% of the training expense, up to $10,000. So there's a lot of different ways that there is access to capital, not necessarily just through the bank, but through other ways, and we're here to help connect you with those people. And one of the things that we were sharing before is that our relationship is with the business owner, but then our job then is to create a case to the adjudicator. And the adjudicator doesn't know me and they don't know you, and so you have to give me as much information about your business so that I can give the strongest case possible, because they are only going to have a certain amount of time to look at all the facts, and they've got that risk hat on. Right. So, you know, as much as we want to be able to support you, it needs to be a partnership, and that's why you want that relationship from the beginning. And just to talk, I'm thinking about this, what do you think about that? Like, use us as that sounding board, because we know what adjudication is going to look for and what the bank's going to look for, and so we want to give you that advice up front.
I have this image of my head that they're locked away in a cell and that you sort of throw them information or something.
There's definitely reasons to talk to your banker outside of debt, right? Like cash management, how are you making payments, how are you receiving payments, what are you doing with your deposits? There's a whole world, and there's certainly commercial portfolios where the majority of clients don't have debt, and there's tons of ways that banks can help. But we will just kind of break down the debt a little bit. So you don't need to know exactly what type of lending product you're going to need going into the bank, but I think it helps to have an idea of what matches with what, so that you can just plan a little bit better, right? So when it comes to things like intangible assets, like your R&D spending, things that aren't necessarily generating cash flow yet, right? So they're unproven. That's where you're probably going to want to use equity to finance that, because again, banks, we look at the cash flow to repay our debt, and if the cash flow is not there, well then probably a great opportunity for equity. Then you've got your current assets, okay, so the assets that you're going to convert to cash within 1 year. Your accounts receivable and your inventory primarily, right? For those, you want to use operating credit because it's going to revolve with your needs, right? So you talked about the seasonality of your business. Maybe right after your peak season, you're flush with cash, and then that slowly depletes right before you ramp up for the new season. So your operating line's going to flow with the cycles too, and then you're only paying interest when you use it, okay? So to figure out kind of a ballpark for how much of an operating line you might need or qualify for, it's typically about 50% of inventory, provided it's not perishable, 75% of accounts receivable. And then to sort of shake that out and make sure the amount makes sense, you're looking at about 10 to 15% of sales or revenue. So if that 10 to 15% of sales or revenue is less than your inventory, we might say, okay, well maybe you're a bit inventory heavy, or we're not comfortable lending quite that much, but that's sort of a ballpark of how much you might get. And then your longer term assets, like your equipment, your leaseholds, your build outs, all of that stuff, you want to use debt that's going to reduce with the life of the asset. So, we'll see often people go and buy some equipment on their operating line. Well, that makes it tough because at the end of the day, when you want to refresh your location or you want to go buy new equipment, you've still got this debt that's hanging on there, but that asset's no longer useful, right? Plus, again, going back to the size of the operating line, if you've now tied up your whole operating line with buying equipment, and you come to the bank and you say, hey, my cash flow's really tight, I need more working capital, I need you to increase my operating line, we might say, well, you're kind of at your max given where your receivables and your inventory are.
So just for any equipment financing, leasehold improvements, along with regular term loans from the bank, there is the CSBFL, the Canada Small Business Financing Loan. The nice thing about that loan is it's 75% insured by the government. So the personal guarantee is only 25%, and we can lend up to 90% loan to value for equipment and for leasehold improvement. So if you have a new space, new practice, and you want to renovate or buy new equipment, we can lend up to 90% loan to value on that.
So you can use term debt too, like if you're expanding by buying another business, or eventually if you want to sell via a share sale, right? Those kind of intangible transactions, if your business has really strong cash flow or the one you're acquiring has really strong cash flow, banks can finance those. And that whole transition succession piece is a huge business for the banks. It's really interesting. So this is definitely an option, and the reason why you would use a term loan for something like that is because it is kind of intangible behind it, right? So you're relying on that strong cash flow, and you really want to just get that debt paid down as quickly as you can to get the businesses performing as quickly as they can. I think you really want to work with people who specialize in kind of what they're doing, right? So even if you had a general valuator, again, all of your businesses could be valued differently, right? It's really important to always compare apples to apples, right? Like, how have businesses exactly like yours been selling? That's more important and meaningful than just hearing how general businesses have been selling, I think. So anytime someone understands your space and can give you the most accurate data, I think it's best. If you can get the financials of the business you're purchasing, ideally, to figure out how the value was, again, figured out in the first place, right? Then that helps us assess the two of them together. Like when you come together, does that company have really strong cash flow, or is it a turnaround story and you're going to take your expertise with your existing company and make something out of it, right? In which case we'd have to look at the cash flow of your existing company to make sure that you can kind of carry all that new debt, right? So there's lots of ways that you can leverage it and lots of levers you can pull around how much are you asking for, how strong is the cash flow, what are you buying, what's going to be created out of it. When you're seeking debt, if you think of your assets like a bit of a pyramid, right? At the bottom is the comfiest, most risk-averse, which is where we sit as senior secured lenders. So we're lending anywhere from 50 to 75% of your assets, okay? When you want to get a bit more leverage, that's 75 to 85, maybe 90% of your asset financing. That's where these kind of players come in. And they're called mezzanine because they're in the middle, really, of your pyramid structure there, or subordinated because they come behind the bank in terms of the rank on your assets, right? So they'll take on more risk than the bank, and sometimes what you'll see is, they'll give you a loan for 2 years. At the end of it, if it's not repaid, they get an equity portion or something like that, right? It's a bit more of the debt and equity piece. And so obviously as you're going up the risk spectrum, the interest rates go up accordingly too to compensate the lender for that. And then you get into the more specialized kind of lenders who are looking, to really ride the growth with you and looking at what are you going to be one day and how can we, share in the exit and all the wealth that the exit will bring. And like Espresso is a local player in that space. In the tech space, they're very big, right, with those intangibles. And then now you're starting to see more non-traditional financing, like the lending clubs, the online peer-to-peer, crowdsourcing, all of that kind of stuff. So that's kind of the spectrum, and there's so many players because everyone uses all different sorts. So don't feel badly if you've got to go down here. They're there for a purpose.
Well, thank you.
Thank you.